We are all giddy. Chairman Powell says that the committee is going to consider a rate cut here in a couple of weeks. So the Fed is acquiescing to a ton of political pressure and they're going to cut rates, even in the face of rising inflation. But we all have high hopes that this will be a good thing and that it will lead to lower mortgage rates and in turn more volume. But will it? And it's really hard to say. It's really hard to say. Now, I'm in the camp that thinks there's a lot of upward pressure on long-term interest rates. I think that most economists outside of the housing and mortgage bubble believe that there's upward pressure on long-term rates. And even if the Fed cuts short-term rates, we're not going to see a significant improvement to the long end of the curve. And 30-year fixed mortgages are definitely the long end of the curve. And in fact, as we all recall, a year ago, when the Fed preemptively cut rates crazily 100 basis points, that mortgage rates went up 100 basis points because the Fed doesn't really control the long end of the curve, certainly not by manipulating short-term interest rates. And what makes me talk about this again, and I get it, many of you are tired of me hearing this. Many of you just want to hear it's going to get better, about to do a lot more business. But I'm more of a mind that let's be great advisors. Let's give our customers great advice. That's why they pay us handsomely. And from our advice, let's create really good and winning strategies for them to not only attain but maintain home ownership. But what got me to speak about this again today is Dr. Torsten Slok from the chief economist at Apollo Global Management, a very well-quoted economist, a highly followed economist. The industry, the finance industry follows Dr. Slok, and I'm a huge devotee to his work. I've quoted it here quite a bit of time. But he came out with a new report called "Why is a Yield Curve Steepening?" because of coming Fed cuts and fiscal challenges. And in this 76-page, highly data-driven report, he argues why there's upward pressure on interest rates. And this is maybe the fifth such study or report that I've quoted in almost as many days. All of them are different and speaking differently on why there's upward pressure on long-term rates. Each of them has a different philosophy or strategy. Now, definitely there might be there are all sorts of political pressure on lowering short-term interest rates. But here's the thing. So, as I've said, the Fed doesn't control the long end of the curve. Now, they can, by the way, they can if they want to, but not by manipulating interest rates. It would be by buying supply. So if they could create change in the curve by creating, demand, right, by buying supply. So, but you know what? If at all the bond vigilantes think that the Fed starts cutting irresponsibly, you're going to see long-term rates go up. That's called steepening of the yield curve, and you might see them significantly. But the biggest pressure, which we've talked about, is this U.S. debt that's projected to grow from 100% of GDP to 150% of GDP, which is crazy. And I shared with you a couple of weeks ago that economists, and I cited 6 different studies, including from the Fed, from every 1% increase of debt to GDP puts about 3 basis points pressure on long-term rates. And so if you really saw it to go up 50 basis points, that's 150 basis points of pressure built into long-term interest rates. So that's a huge problem. And then we have a massive reissuance. We need not only are we selling new debt, but we have to reissue like $7 trillion of old debt. So we have this massive supply out there, just massive supply. And then, of course, our debt servicing costs are now getting to $1 trillion in annual interest payments for the United States. All this is huge problems. There's all sorts of inflationary challenges out there, which have nothing to do with tariffs. I'm not saying tariffs are going to drive inflation. I'm not even saying that. I'm just saying, look, debt, all this oversupply of bonds are all going to cause problems in the face of increasing inflation. And I understand the Fed's dual mandate that they have to optimize employment while, maintaining a healthy economy. But most economists think that around 4% we're at full employment. I mean, it's not like we have a massive unemployment problem. We're at pretty much full employment, just that the employment market is weakening, which I totally understand. But here's the key takeaway, and this is what my message really is today. If you're a loan officer, here's what I believe. I believe that long-term interest rates have a lot of upward pressure, but we're going to see little boomlets where they dip. It's like Barry Beebs always said, interest rates travel like on an escalator with a kid with a yo-yo. So even though the escalator is going up, the yo-yo is going up and down in that escalator. And so as that yo-yo goes up and down, as it hits the downtime, a lot of time that creates just a little boomlet of refi opportunity. But it's only flashing. It's very short-lived. And the way that you can capitalize on it is you have to have your pipeline ready. By ready, you have to have full apps that are totally pre-approved in your pipeline. You need to have a strike price or an agreed to rate that you can lock without further authorization so that when the market hits that rate, you auto lock. Think about it. We went back when rates dipped in the third quarter of last year. We took a massive amount of applications, but only 10% of those applications closed because they were unprotected. Whether the consumer thought, hey, look, I think rates are going to keep improving, don't lock me, or the loan officer didn't give good advice, also maybe believing that interest rates were going to continue to improve as analysts kept telling us, but we were totally unprepared to protect in the gains that we could have had. Well, we're going to get down, we probably are going to inch down just a little bit more, and I'm telling you, if it works for your clients, lock them in. Lock them in. Now, whether rates get down to 6.5, 6.25, depending on where you work, 6 1/8, depending on what kind of platform you're on and how you're structured. And by the way, at 6 1/8, 5 million people, 5 million homeowners can benefit from a rate and term refinance. So it's significant, right? But you got to go talk to your clients. What rate makes sense? And by the way, when I say can benefit, the statistic is, it's a worthwhile refinance if you can improve your interest rate by 3/4 of a point. So around 6 1/8, 5 million, just below 5 million homeowners can improve the rate by 3/4%, making it worthwhile. So there's plenty of people can do it, but you just have to be on top of it because it's going to touch these low levels and go back up, just like it did last year. Now, let's say I'm wrong. Let's say, gosh, Ron, you're a political science major, you're ding dong, you're wrong. Fine. What's happened? If you're in process, you can renegotiate the rate. If you close the loan and you've already helped the borrower improve their monthly payment and they get the opportunity to do it a second time, good for you. Good for them. You can do a no-cost refi and lower it again. Do it again. But what happens if I'm right and the plethora of economists are right and you don't advise your clients to lock the rate when it gets down there? You don't have a strike rate that will work and you don't lock it. Well, like last year, 90% of these people aren't going to be able to benefit from the opportunity to dip in rates. And that's a far worse outcome than you lock too early. There's solutions for locking too early. There's no solutions for locking too late. And so I seriously recommend get it locked and loaded, man. Just get your pipeline ready. That's where we can start to earn our money, advising our clients really well, helping them time the market that when it benefits them, jump on it. And if you can jump on it again, jump on it again. And so there you go. Let me just quickly show you this report. I'm going to put a link to this. So check it out. You can see it's 76 pages of just pure data. I'm not going to go through all the data. I just want to show you what it looks like. So it goes through all sorts of, explains to you all these things. It's like 70 charts of why there's upward pressure. And I could keep going through it, but you get the sense. Check it out yourself. If you want to become an expert, or not expert, better informed on interest rates, this is something you need to follow. Just like, by the way, you need to follow MBS Highway every day. You got to listen to Barry every day. Barry is very bright. Listen to his point of view, and you got to follow John Malden and John Malden's faculty, and you got to follow Torsten Slok, and you got to follow, Wolf Richter. You got to follow Mike Frantantoni at the NBA. He's very sober about his predictions on interest rates. He's not Pollyannish. And so, study these economists, become better advisors, become a better instrument to help your clients, manage and maintain home ownership, which is really great. With that, I did do a post on this on LinkedIn today. I saw my little socials come up. Check me out on socials if you like. I hope you're having a great weekend, and thanks for giving me a little bit of your time. I look forward to talking again soon. Thanks so much.